Before you pay your 2026 Medicare premium, stop. That bill may not be based on your life today. It may be based on a tax return from 2 years ago. And that is the part nobody warns retirees about. You can retire, stop working, lose income, and think your high income year is already behind you. But Medicare may still be looking backward at one old tax return, one Roth conversion, one IRA withdrawal, one capital gain, 1 year that looked temporary when it happened. Then the notice arrives later, and suddenly your Medicare premium is higher, not because you missed a payment, not because you broke a rule, but because your income crossed a line Medicare still remembers. This is the Medicare cliff. And in 2026, at the highest level, when Part B and Part D IRMAA stack together, the extra charge can reach about $578 a month. That is not the normal retiree's bill, but it is the warning. Because smaller cliffs can hurt too. A few extra dollars of income in the wrong year can push a retiree into a higher premium bracket. And the worst part is this. Most people look at the monthly amount. They never check the tax year behind it. That is how the mistake survives. So before you ask, why is my Medicare higher? Ask the more dangerous question. Which tax return did they use? Because the bill in your hand may have started 2 years ago. Now look at what makes this so dangerous. A Medicare premium notice feels like a current bill. It arrives now. It affects this month. It comes out of the check now. So naturally, a retiree thinks it must be based on life right now. But that is not always how this works. For 2026 Medicare premiums, the income number is generally pulled from an older tax return, usually the 2024 return. That means your 2026 bill may be reacting to money you received 2 years earlier. Not what you're living on today, not what your bank account feels like today, not what your retirement income looks like today. An old year, an old return, an old income number. That is where the cliff begins. Imagine a retiree named Robert. In 2024, Robert had one unusual year. Maybe he sold investments because the market was up. Maybe he took a large IRA withdrawal to fix the house. Maybe he did a Roth conversion because someone told him it was smart planning. Maybe interest rates were high and his savings account finally paid real income. Maybe his wife was still alive then and they filed jointly. At the time, Robert did not think he was creating a Medicare problem. He thought he was making normal retirement decisions. One sale, one withdrawal, one conversion, 1 year. Then 2024 ends. The tax return gets filed. Robert moves on. But Medicare does not move on as fast as Robert does. 2 years later, in 2026, the notice arrives. Now Robert is older. Maybe he is fully retired. Maybe his income is lower. Maybe that Roth conversion is long gone. Maybe the investment sale was never repeated. Maybe his household changed. But the Medicare notice is still pointing backward. That is why retirees feel blindsided. They say, I do not make that kind of money anymore. And they may be right. But the system may not be looking at anymore. It may be looking at then. That is the trap. The bill arrives today, but the trigger may have happened 2 years ago. And if you only stare at the premium amount, you miss the real question. Do not start with the dollar amount. Start with the tax year. Which return did they use? Was it a normal year? Was it a one-time income year? Was your filing status different? Was your household different? Was your income lower after that year? Because if you do not check the year behind the notice, you may treat the bill like a mystery. It is not a mystery. It is a chain. Tax return first, income number second, Medicare bracket third, higher premium last. Most retirees only see the last step. That is why they panic. That is why they pay. And that is why they never catch the real source of the problem. So when the notice arrives, do not just ask, how much is the premium? Ask, what year is this premium accusing me of? Because sometimes the bill is not judging your retirement today. It is punishing one income year from the past. Now here is where retirees get trapped. They think IRMAA is only a problem for extremely rich people. They hear higher income Medicare premium, and they stop listening. That is the mistake, because this cliff is not always triggered by some luxury lifestyle. It can be triggered by normal retirement moves, a withdrawal, a conversion, a sale, a pension, a savings account, a year that looks harmless until every piece lands on the same tax return. That is how the Medicare cliff is built, not from one scary number from a stack. Traditional IRA withdrawals can count, 401k, withdrawals can count, pension income can count, part-time work can count, capital gains can count, dividends can count, bank interest can count, taxable Social Security can count, Roth conversions can count, even tax-exempt interest can matter for the Medicare income calculation. That last one catches people because retirees hear the words tax-exempt and think it disappears. For regular income tax, maybe. But Medicare may still see it when calculating the income number used for IRMAA. So a retiree may think, I did not do anything unusual, but the tax return says something different. Maybe the IRA withdrawal was only for one repair. Maybe the Roth conversion was only for future planning. Maybe the investment sale was only to raise cash. Maybe the bank interest was only higher because rates changed. Maybe the capital gain came from one old position finally being sold. Individually, each move can look reasonable. Together, they can push the income number over the line. That is why this is dangerous. The system does not care that the money came from different places. It does not separate your life into little stories. It does not say, this was for medical bills. It does not say, this was only one time. It does not say, this retiree was just trying to simplify. It sees the tax return. It sees the income number. Then the premium calculation begins. And if this is the kind of retirement rule nobody explained to you clearly, subscribe now, because this channel is built for one thing: helping seniors catch the rule before the bill arrives. Now keep watching this part carefully, because this is where many retirees make the wrong assumption. They think the problem is the big move, but sometimes the problem is not one big move. Sometimes it is several small moves landing in the same year. A little more interest, a little more dividend income, a small capital gain, a required withdrawal, a pension check, a Social Security benefit, then one extra IRA withdrawal gets added on top. That is the moment the year changes. Not emotionally, not visibly, but on paper. And Medicare lives on paper. That is why you cannot look at retirement income month by month only. A monthly check can feel normal. A tax year can look completely different. You may feel like you're living carefully, but the return may show stacked income. And that stacked income may be enough to move you into a higher Medicare premium bracket later. This is especially dangerous for retirees who are between decisions. A retiree sells a home, then moves money, then takes a withdrawal, then pays taxes, then adjusts investments. Each step feels separate, but the tax return combines them. That is where the cliff hides, not inside one decision, inside the order, inside the timing. Inside the year, everything hits together. So, before you take a large withdrawal, sell an investment, convert IRA money to Roth, or assume tax-exempt interest does not matter, pause. Ask one question. What will this do to my Medicare income number? Not just my tax bill, not just my cash flow, not just my account balance, my Medicare income number. Because the tax bill may hurt once, but the Medicare premium can come back later, month after month. And by the time the notice arrives, the move that triggered it may already feel like old history. That is why retirees miss it. They remember the withdrawal. They remember the sale. They remember the conversion. But they do not connect it to Medicare 2 years later. And that delay is exactly what makes the cliff so easy to miss. Now, let's talk about the number in the title. $578 a month. That number sounds extreme. And for many retirees, it will not be that high. But the point is not that every retiree pays the maximum. The point is that Medicare has cliffs. And when you cross the wrong line, the premium does not politely warn you first. It jumps. For 2026, the standard Medicare Part B premium is $202.90 per month. That is the number many retirees expect. That is the number they plan around. That is the number they think Medicare means. But high-income retirees can pay more, much more. At the highest IRMAA level, the Part B premium can rise to $689.90 per month. So compare those two numbers. Standard Part B, $202.90. Highest Part B, $689.90. That difference is $487 extra per month. And Part B is only one side of the problem. If the retiree also has Medicare drug coverage, Part D IRMAA can add another charge. At the highest level, the Part D IRMAA can be $91 per month. Now stack them. $487 extra for Part B, $91 extra for Part D. Together, that is $578 more per month. That is the Medicare cliff. Again, not every retiree pays that amount. But the number proves the danger. Because this is not a tiny billing adjustment. This can become a second monthly bill hiding inside Medicare. And even if a retiree is nowhere near the highest level, the smaller cliffs still matter. Because the pain is not only the amount. The pain is the surprise. A retiree may think one extra IRA withdrawal created only an income tax issue. Then Medicare responds 2 years later. A retiree may think one Roth conversion was smart long-term planning. Then the premium notice arrives. A retiree may think one investment sale was just a cleanup move. Then the old tax return gets used for Medicare. That is why the word cliff matters. This is not always a smooth increase. It can feel like standing one step below the line, then $1 over the line, and suddenly the monthly premium changes. That is what scares retirees when they finally understand it. It is not only how much income you had. It is where that income landed, what year, what filing status, what bracket, what Medicare saw on the return. And once the notice comes, the system is not asking how careful you felt. It is reading the number. That number may include income you do not think of as dangerous. Capital gains, interest, dividends, IRA withdrawals, pension income, Roth conversions, taxable Social Security. Even tax-exempt interest can be part of the Medicare income calculation. So the trap is not just being wealthy. The trap is crossing a threshold without realizing it. That is the part that hits ordinary retirees, because they are not trying to live rich. They are trying to manage retirement. They are trying to fix the house, help a family member, move money into safer accounts, convert before required withdrawals start, sell an investment before the market drops, or create more cash because everything costs more. But Medicare does not hear the reason. It sees the income year. And if that year pushes the number high enough, the premium can change later, month after month. This is why the old advice is incomplete. People tell retirees, watch your tax bracket, watch your capital gains, watch your withdrawals. But they forget to say, watch your Medicare bracket too. Because a move can look acceptable for income tax and still create Medicare pain. That is where smart retirees get blindsided. They planned the tax, they forgot the premium, they looked at April, they forgot 2 years later. And that delay can make the mistake feel invisible until the bill is already in front of them. So when you hear $578 a month, do not hear it as a scare number. Hear it as a warning label. The system has levels. The levels have thresholds. And crossing one can turn one old income year into 12 months of higher Medicare costs. That is the piece many retirees never calculate. They calculate the withdrawal, they calculate the tax, they calculate the cash they need. But they do not calculate the Medicare echo. And that echo can arrive long after the original decision feels finished. So before any large income move in retirement, do not only ask, how much tax will I owe? Ask, will this income year follow me into Medicare later? Because if it does, the real cost may not end when the tax return is filed. It may keep coming back as a premium. Now pay close attention here, because this is where retirees make the wrong move. They see the higher Medicare premium, they get angry, they get confused, they think the bill itself is the problem, but the bill is only the final result. The real problem may be hidden 3 steps behind it: the tax year, the filing status, and the income number. If you do not check those 3 things, you are arguing with the smoke while the fire stays hidden. So when the notice arrives, do not start by panicking. Do not start by assuming Medicare is wrong. And do not start by quietly paying it without looking deeper. Start with the chain. First, check the tax year. This is the most important step. Look at which tax return was used to calculate the premium. For 2026, the number usually points back to 2024. That means the notice may not be judging your current life. It may be judging an older income year. And that older year may not represent your real situation anymore. Maybe you were still working. Maybe your spouse was still alive. Maybe you sold an investment. Maybe you took a large withdrawal. Maybe you had one unusual income event that never repeated. If you do not check the tax year, you may never understand why the bill changed. You will just stare at the premium and feel trapped. That is exactly what many retirees do. They look at the amount, they never look at the year. Second, check the filing status. This matters more than people think. Were you single? Married filing jointly? Married filing separately? Did your household change after that return? Did a spouse pass away? Did a divorce happen? Did you retire after that year? Did your income drop after that return was filed? Because the filing status can change the income threshold. And when the filing status changes, the same income can feel very different. A married couple may have crossed one line together. Then later, one spouse is alone. Now the survivor may be living on less income, but the Medicare notice may still be tied to an old return or an old household picture. That is why you do not just check the number, you check the status behind the number. Third, check the income number, and this is where people get careless. Do not only ask, what was my taxable income? That is not enough. For IRMAA, the number is based on modified adjusted gross income. For many retirees, that means adjusted gross income plus tax-exempt interest. That one detail can surprise people because they hear tax-exempt and think it cannot hurt them. But for Medicare, it may still matter. So look at the full income picture. IRA withdrawals, 401k withdrawals, pension income, taxable Social Security, capital gains, dividends, bank interest, Roth conversions, part-time income, tax-exempt interest. Any one of these may not look dangerous by itself, but together they can build the number Medicare used. That is why the notice is not just a bill. It is a clue. It is pointing backward. It is telling you there was a year, a filing status, and an income number that pushed you into a higher premium level. Your job is to trace it, not guess, not panic. Trace it. Find the year, find the status, find the income number. Then ask the next question. Was that year normal? Was that income repeated? Is my income lower now? Did a major life event happen after that tax return? Because sometimes the number used may be technically correct, but your current situation has changed, and that is where many retirees stop too early. They think, the IRS number is correct, so there's nothing I can do. Not always. Sometimes the old tax return is correct, but the current premium may still deserve review if a qualifying life-changing event reduced your income. That is why this check matters. You're not just looking for a math error. You are looking for the story behind the number. What year did they use? What changed after that year? What proof do you have? That is the difference between complaining and taking action. Complaining says, this bill is too high. Action says, here's the tax year they used. Here is why that year does not match my current income. Here is the life-changing event. Here is the proof. That is a completely different conversation. So before you pay the higher amount month after month, check these three things: the tax year, the filing status, and the income number. Because if you skip this step, you may never know whether the premium is correct, outdated, or reviewable. And the most expensive mistake is not always the higher bill. Sometimes the most expensive mistake is accepting it without checking the chain. Now, here is the part many retirees miss. A higher Medicare premium notice does not always mean you are stuck, but it also does not mean every retiree can make it disappear. This is where people get bad advice. Someone hears about an appeal. Someone hears about a form. Someone says, just file SSA-44. No, do not treat this form like a magic button. That is how people waste time, send the wrong paperwork, and still keep paying the higher premium. SSA-44 has a specific job. It is used when a major life-changing event reduced your household income. That sentence matters. Not just a bill you dislike, not just a premium that feels unfair, not just a high-income year you regret, a life-changing event, and a lower income after it. That is the key. So before you think about SSA-44, ask the real question. What changed? Did a spouse pass away? Did a marriage happen? Did a divorce or annulment happen? Did work stop? Did work hours reduce? Did pension income drop? Was there a loss of income-producing property? Was there an employer settlement payment? These are the kinds of events Social Security looks at for an RMA life-changing event review. And this is where the distinction matters. A Roth conversion by itself is not automatically a life-changing event. A normal investment sale by itself is not automatically a life-changing event. Taking a large IRA withdrawal because you wanted cash is not automatically a life-changing event. Selling stock at a gain is not automatically a life-changing event. That may feel unfair, but the system is not asking whether the old income year was annoying. It is asking whether a qualifying event changed your income situation. That is why retirees need to slow down. Do not call Social Security and only say, my premium is too high. That is weak. That gives them nothing to work with. Instead, build the chain. Here is the tax year they used. Here is the income number from that year. Here is what changed after that year. Here is why my current income is lower. Here is the life-changing event. Here is the proof. That is a stronger conversation. Because now you are not just complaining. You are requesting a review based on the rule. And proof matters. If work stopped, you may need proof that work stopped. If work was reduced, you may need proof that income went down. If a spouse passed away, you may need documentation. If pension income dropped, you may need records. If income-producing property was lost, you may need evidence. Do not wait until the bill has been draining your check for months before you start gathering papers. When the notice arrives, check it immediately, because the longer you ignore it, the easier it becomes to treat the higher premium like normal, and that is exactly how retirees lose money quietly. 1 month, then another, until the shock becomes routine. Do not let that happen. If the tax year is old and your situation changed, investigate. If your income is now lower because of a qualifying life-changing event, ask Social Security about the IRMAA review process. Ask about Form SSA-44. Ask what proof they need. But keep this clear. SSA-44 is not there to erase every high-income mistake. It is there to update the picture when life changed and income dropped. That difference can save a retiree from false hope. And it can also stop a retiree from giving up too early. Because some people really do have a reviewable situation. They retired after the tax year Medicare used. Their work stopped. Their spouse died. Their pension changed. Their household income fell. But they keep paying because they assume the notice is final. Final does not always mean uncheckable. Correct does not always mean current. And old income does not always describe today. That is the opening. Not anger. Not guessing. Documentation. You're trying to show Social Security that the tax return they used no longer reflects your current household income because a qualifying life event changed the picture. That is the mindset. So remember this line. Do not ask, can I escape IRMAA? Ask, did a qualifying life-changing event reduce my income after the tax year they used? That is the real question. And if the answer is yes, do not sit there hoping the premium fixes itself. Check the notice, find the year, gather the proof, contact Social Security, and ask for the review the right way. Now bring this down to action, because fear does not protect your check. A checklist does. If a 2026 Medicare notice shows a higher premium, do not throw it aside. Do not assume it is automatically wrong. Do not quietly pay it for months without checking what caused it. Run these 7 steps. Step 1, open the notice and find the tax year used. Do this first, not the premium amount. not the frustration, the tax year. For 2026, the income number may generally come from the 2024 tax return. So ask, is this notice looking at my life now, or is it looking backward? Step 2, check your filing status for that year. Single, married filing jointly, married filing separately, widow or widower situation. Household changes matter. A filing status can change the threshold. A spouse passing away can change the whole picture. A divorce can change the whole picture. A retirement year can change the whole picture. Do not skip this. Step 3, check the income number, not just the number you remember, not just the number that felt normal. Look at the return. For IRMAA, the Medicare income number is generally based on modified adjusted gross income. For many retirees, that means adjusted gross income plus tax-exempt interest. That means the number may include more than you expected. Step 4, circle the unusual income. This is where the trap usually hides. Was there an IRA withdrawal, a 401k withdrawal, a Roth conversion, a capital gain, a home sale with taxable gain, higher bank interest, dividends, part-time work, pension income, taxable Social Security, tax-exempt interest? Do not ask whether each item felt reasonable. Ask whether it landed on the same tax return, because the system stacks the year. Step 5, compare the old year with your current income. This is where many retirees finally see the problem. The old return may be correct, but your current life may be different. Maybe you stopped working. Maybe your hours were reduced. Maybe your spouse passed away. Maybe pension income changed. Maybe income-producing property was lost. Maybe the old year was a one-time spike. Write down what changed. Do not rely on memory. Put the facts in front of you. Step 6, ask the SSA-44 question the right way. Not, how do I get out of this bill? Ask, did a qualifying life-changing event reduce my income after the tax year Medicare used? That is the real question. If the answer is no, the higher premium may still be correct, even if it feels painful. If the answer is yes, you may have a review path. That is when you ask Social Security about the IRMAA review process and Form SSA-44. Step 7, gather proof before you call. This is not the time to be vague. If work stopped, gather proof. If work reduced, gather proof. If a spouse died, gather documents. If pension income dropped, gather records. If income-producing property was lost, gather evidence. You want to show the chain clearly. Here's the tax year used. Here's the income from that year. Here is the life-changing event. Here is the current lower income. Here is the proof. That is the difference between panic and action. And remember this, the goal is not to fight Medicare emotionally. The goal is to verify the calculation. If the premium is correct, you need to know why. If the tax year is old, you need to know that. If your income changed after a qualifying event, you need to know whether a review is available. But do not do nothing. Doing nothing is how the higher premium becomes normal. 1 month passes, then another, and soon the retiree stops questioning it. That is the danger, not just the bill, the silence after the bill. So when the notice arrives, treat it like a warning document. Not trash, not a mystery. A warning document. It is telling you a tax year was used, an income number was found, a filing status was applied, and a Medicare premium was changed. Your job is to check the chain before the higher amount drains your check quietly. Because the Medicare cliff does not always hit when the income happens. It can hit later, after the withdrawal, after the conversion, after the investment sale, after the tax return, after the retiree thinks the year is finished. That is why this rule is so dangerous. It waits, and retirees who do not look backward may never understand why the bill moved upward. So do not guess. Check the year, check the status, check the income, check the life event, check the proof, then take action. Because the worst sentence a retiree can say is, I thought there was nothing I could do. Sometimes there is nothing to change, but sometimes there is something to review, and you will not know which one is true until you check the chain.